Hi everyone. In our previous video, we discussed debt securities classified as held to maturity. In this video, we'll discuss debt securities classified as trading securities. Some companies, primarily financial institutions, actively and frequently buy and sell securities, expecting to earn profits on short-term price fluctuations. Investments in debt acquired principally for the purpose of selling them in the near future are classified as trading securities. The holding period for trading securities generally is measured in hours and days rather than months or years. These investments typically are reported among the investor's current assets. Usually only banks and other financial institutions invest in securities in the manner and for the purpose necessary to be classified as trading securities. Just like held to maturity investments, trading securities are recorded at cost when they are purchased, and any discount or premium is amortized to interest revenue over time as periodic interest payments are received. However, in subsequent periods, there are two important differences between trading securities and held to maturity investments. First, trading securities are written up or down to their fair market value in the balance sheet, while the held to maturity securities are kept at amortized cost. Writing securities up or down to their fair value is also known as marked to market. Second, corresponding unrealized holding gains and losses on trading securities are included in net income in the income statement. Held to maturity securities do not include unrealized holding gains and losses in net income. Reporting trading securities at their fair value is a departure from amortized cost, which is the way many assets are reported in the balance sheet. Why the difference? For trading securities, fair value information is more relevant than for other assets intended primarily to be used in company operations, like buildings, land, and equipment, or for debt investments intended to be held to maturity. For that reason, it makes sense to report unrealized holding gains and losses on trading securities in net income during the period that fair value changes, even though those gains and losses haven't actually been realized through the sale of the securities. Unlike held to maturity securities, trading securities are carried at fair value in the balance sheet, so their carrying value must be adjusted to fair value by the end of every reporting period. Rather than increasing or decreasing the investment account itself, we use a valuation allowance called fair value adjustment to increase or decrease the carrying value of the investment. At the same time, we record an unrealized holding gain or loss that is included in the income statement in the period in which fair value changes. Remember, the gain or loss is still unrealized because the securities haven't been sold. In referring back to our earlier examples, let's say United is a bank or other investment company and has acquired the Masterware bonds expecting to make a profit on short-term price fluctuations. Under those conditions, United should classify the bonds as trading securities and would need to report the bonds at their fair value of $714,943 on December 31st, 2021. The bonds currently are recorded at their amortized cost of $671,297. Let me show you where that number came from. As shown on the amortization schedule we prepared in our first video lecture, the amortized cost of the bond is $671,297. But the fair value of the bond at December 31st, 2021 is $714,943. So the fair value adjustment account needs a debit balance of $43,646. United will recognize whatever unrealized holding gain or loss is necessary to move the fair value adjustment account from its current balance, which is 0 at this point, to $43,646. As shown on this journal entry, we need to debit the fair value adjustment account and credit gain on investments in the income statement. Now let's assume that United sells the bond for $725,000 on January 5th, 2022. To account for the sale, United needs to do two things. First, United needs to update the carrying value of the bonds to the fair value and record net income any unrealized holding gains and losses that occurred during 2022 up to the date of sale. Second, on the date of sale, United needs to record the receipt of cash and remove the amounts associated with this investment from the relevant balance sheet accounts. Let's look at the calculations and record each of these entries. First, we need to adjust and update the fair value adjustment account and recognize any unrealized holding gains or losses that have occurred during the current period prior to the date of sale. We already have accounted for the fair value changes that occurred in 2021. Now we need to record the additional fair value changes and their related unrealized holding gains and losses that have occurred in 2022 up to the moment of sale. Companies might record these changes in fair value at the end of each day, but for our example, we will use a single summary entry that captures those changes in fair value up to the moment of sale. Remember that on December 31st, 2021, we recorded a fair value adjustment of $43,646 to adjust the balance shown on the balance sheet to its fair value of $714,943 on that date. Now, on January 5th, 2022, the fair value of the bond has increased further to $725,000. So we need to update the fair value adjustment for an additional $10,057 to account for the increase in fair value. Look at the way that's calculated. Compare the fair value with the amortized cost to calculate what the ending balance in the fair value adjustment account should be. Then look at the existing balance in the account and calculate whatever adjustment is necessary to get the account balance to where it needs to be. The account had a debit balance of $43,646. It should have a debit balance of $53,703. So we need to debit the account by an additional $10,057 to move that balance to where it should be. So the journal entry on January 5th is debit fair value adjustment $10,057 and credit gain on investments in the income statement, $10,057. Now we need to record the sale transaction. After making the previous journal entry, the investment is carried at its fair value as of the date that it is being sold. And we have already recognized the gain arising from the difference between the amortized cost and the fair value as of the date of sale. All that remains is for United to record receipt of cash and remove the balances for the bond from the investment-related accounts on the balance sheet. For simplicity, we are going to ignore the interest earned during the first 5 days of 2022. As with the sale of the held-to-maturity investment, we record receipt of $725,000 of cash and remove all the balances associated with this investment from the investment-related accounts on the balance sheet. However, unlike held-to-maturity investments, our trading securities account has an additional balance sheet account, the fair value adjustment account. It has a debit balance, so we will need to credit that account when we record the sale. Another difference between held-to-maturity and trading security approach is that because we carry trading securities at fair value, the gain or loss associated with changes in the fair value have already been included in net income. So there will be no gain or loss to recognize in this journal entry. So, the journal entry is debit cash, $725,000 for the cash we received. Debit discount on bond investment, $28,703 for the unamortized balance of the discount. Credit investment in bonds for the $700,000 par value, and credit the fair value adjustment account for the $53,703 balance in the debit balance in the account. We have to credit that account for that amount to zero out its balance. Over the life of the investments, United recognized $53,703 of gain under the trading securities approach. $43,646 was recognized in 2021, and $10,057 of gain was recognized in 2022. Do you remember the gain we recognized under the held-to-maturity approach when investment sold the bonds? Let me show you. This is the slide we looked at when we discussed the sale of a held-to-maturity investments. And will you look at that? We recognized a gain on the sale of the investment of $53,703. So the same amount of gain was ultimately recognized under both approaches. The only difference is timing. Under the trading securities approach, unrealized holding gains and losses from fair value changes are recorded as income as they occur. But under the held-to-maturity approach, gains or losses are not recorded until the investment is sold. Trading securities appear in the financial statements as follows: income statement and statement of comprehensive income. For trading securities, gains and losses are included in the income statement in the periods in which fair value changes, regardless of whether they are realized or unrealized. Investments in trading securities do not affect other comprehensive income. Balance sheet. Investments in trading securities are reported at fair value, typically as current assets. Cash flow statement. Cash flows from buying and selling trading securities typically are classified as operating activities because the financial institutions that routinely hold trading securities consider them as part of their normal operations. Well, this is turning out to be a pretty long video, and we're not quite finished with it yet. So let's take a quick bonus point break. I'll award 5 bonus points to the first 28 students in this class who email me a picture of a duck before 11:59 p.m. on Wednesday, September 9th. Shh! Don't tell anyone. You don't want other students to get their pictures in before you. Let's do another concept check problem. Please pause your video while you consider which of the following A through D is false about trading securities. A. Trading securities are carried at fair value in the balance sheet. B. The investment account is increased or decreased to reflect the fair value. C. Unrealized holding gains and losses on trading securities are included in the net income of the income statement. Or D. Trading securities typically are intended to be sold in the near future. When you have made your selection, please start the video again and check your work. The correct answer is B. Rather than increasing or decreasing the investment account itself, we use a valuation allowance, fair value adjustment, to increase or decrease the carrying value of the investment. Well, that's it for this video. In our next video, we will talk about debt investments classified as available for sale securities. See you next time.